Morning, everyone. It is Sunday, December 26th. I hope everyone had a very, very Merry Christmas and/or wonderful weekend. Okay, we're going to do our weekly review. This supports the report that all of you have received, or you can receive. You just go to the website and sign up, or send me an email, tom@alexandertrading.com, and I'll put you on the list and you'll get the written report that I send out every weekend. There's a lot of additional information in that report. For one thing, you can go back and you can look at the previous 4 reports. And I do that intentionally because I want everyone to see what I'm saying and then be able to go back and check what I'm saying. And it's not me. I am not a market guru. I'm just someone who has been trading for almost 4 decades and who has completely immersed themselves in auction market principles, which are the guiding force behind market behavior on many different levels. And I have much more coming in the next week or two on that. And some things we're going to begin to take a look at in addition to what you see in the reports that support the auction market worldview, and maybe even make it a little more granular. I know this is the report that I do on a week-to-week basis is more of a sort of an overview. So anyway, without further ado, also, if you would subscribe to my channel, that would be very helpful. If you like the video, like it. And please, by all means, feel free to share this anywhere and everywhere in social media world. It's a world that I am stay out of to the largest degree possible, but I digress. Okay. Looking at the indices, which you're not doing because I've got to share my screen. Okay. Now, what you see here, these are the 4 primary U.S. trading indices, the cash indices. You can see the S&P, the SPX closed a new all-time high ground. Clearly, it is the only index to have done so far. Now, there obviously can be a lag, but as I've said many, many times, you're not going to have a ripping bull market unless all 4 of the indices are pretty much from a structural perspective in the same position, and they are not at all right now. In particular, the Russell has a long way to go. Now, also typically, and what you will see at least every bull market top that I've participated in since the mid-1980s, you have divergences at higher highs, new all-time highs among the indices. Now, that's a process that can go on for many, many months before there's some sort of confirming downside signal that, oh, we're in a bear market. But it is a sign. It's just something that I've mentioned this before many times. We had the Russell for 8 months trailing, and it did not hold back the other 3, the Dow, the NDX, NASDAQ, or the S&P. Now, once again, the Russell has tested a critical downside level and it's bouncing off that level. So the benefit of the doubt for now goes the upside. The levels you see highlighted on my screen here are important levels as we head into trade on Monday. Now, obviously, it's another holiday week. It is typically among the lowest volume weeks of the year. That doesn't mean there can't be or won't be sizable volatility. It's just that if anything, it makes volatility a more ideal condition for volatility because we don't have the typical volume liquidity that you have when everybody is actually at their trading desk. Anyone that doesn't have to be at a trading desk next week probably isn't from an institutional perspective, and it's the institutions that drive the big money. So you have junior at the trading desk, and that's can make for an interesting situation sometimes. So this is where we are now. The downside levels, and when you're in an uptrend, I've said this many times, there is an incredibly accurate, timeless guideline, especially in uptrends, where when you are in an uptrend, it's the previous day's low extreme or the day before that's low extreme that almost always holds. And when it doesn't, or they don't, then that's a signal that the market has become extremely two-sided and that immediate higher highs aren't as likely as balance or deeper retracement. Now, as I put in the report, what would be bearish at this point would be a close below last Wednesday's lows by all four of these indices, all four of them, not one of them or two of them, all four of them. To the upside, you can see there is nothing above present levels in the S&P, above the high of the 22nd of November, which is not far. You know, the high on the 23rd didn't quite get there. There's nothing above there except magic numbers, and I don't do magic numbers. Now, on the other hand, the other indices have more defined trading levels above, and in particular, if you look at the NDX, this is an important inflection point. You're not going to hang around this level for long. You are either going to screen through it or you're going to form some balance. And I'll get into those probabilities in just a minute when we take a look at market breadth. Also, the Russell has a level not far above where we are. The Dow is sort of in the middle of nowhere. Really, to me, the most significant next level in the Dow is going to include its all-time high. Well, let's take a look at, take a quick view of the profiles. This is the Russell. You can see this is that downside level that's been tested about a dozen times. And now we bungee jump back up into this range, but here's the level we're looking at to the downside. This is the level we're looking at to the upside. These charts are in the report. You can click on those charts and it will enlarge them. Let's see, S&P, same deal. This is what's that, Thursday's low, and then I wouldn't be surprised to see some trade into Wednesday's range. This is all-time print high here. Let's see. Let me find, here we go, NDX. And this is really, here's your upper extreme, and then the downside would include Thursday's low and a little bit into Wednesday's range, etc. So see, which one have I not covered? I think, did I do the Dow? Okay, similar situation, but I do think that the next level in the Dow of significance is the all-time high, and then to the downside, Thursday's low and some into Friday's range. You know, we'll have Globex tonight. That could be rather interesting. So we'll see. Okay, let's take a look at the technical perspective. And when I say technical, I'm referring to NYSE breadth, NYSE advancing minus declining issues. Very simple stuff, but it's something I've used, again, for almost 4 decades and is extremely consistent. This is my entry into the magic number sweepstakes that we always have when the market is in all-time high ground and the magicians come out of the woodwork predicting where the market will stop on a dime because of some mystical, magical effect on the market. So this is my entry into the magic game. But now let me show you how I derived my magic. This would be about a 6.87% rally off of this price low, which is derived from this negative 2000 reading. So this negative, this was the momentum low. This was the price low. We had another negative 2000 reading here. So the 6.87% is the least gain following a price low, following the momentum low of negative 2000 Brent. You know, it's a guess. It's more objective than the other guesses out there about, you know, which fib level this hits, and it will probably land close to a fib level because it can't help it, because there are a skillion fib levels off of extensions and retracements, etc. So anyway, that's a guess. Now back to this. Breadth is on a 3-day basis, and I typically use 5 days, but for this I use 3. The last time breadth reached this level, 3-day breadth, advancing, I'm sorry, not breadth, advancing issues, NYSE advancing issues. It was right off the March 2020 low. And of course, that was the most compressed selling in my lifetime, in any of our lifetimes. And you know, you can make a case it was the most compressed selling in a short period of time ever. And so the market exploded to the upside off of that level, and it generated, shortly after that bottom in March 2020, it generated a 3-day breadth reading right about where we are now. Now, I'm not suggesting there are 2 different market conditions here, because by no means was this a super compressed downside level. This is just basically, this decline was business as usual following that March 2020 low. So we have another negative 2000 breadth reading. Now this level is going to be very, very important going forward. I will say that. But for now, what we want to see, what is most likely to happen going forward? Well, what I can almost guarantee, like 99% guarantee, that the next 4 days are not going to go up at the same rate of change as the last 4 trading days. So if you're chasing this market, you are increasingly playing musical chairs, and it's 1 for 1. What is more likely to happen, the likeliest thing, frankly, is for the market to continue higher, but to grind higher and to have more day-to-day overlap where you're testing a previous day's low, or maybe even the second day low back. And right now we basically have gap. This wasn't a gap, but it was almost an immediate up. And then on Wednesday and Thursday, we had the gap. This gap up and run is coming to an end. So I would expect to see more rotation on a day-to-day basis. That's information, especially for you day traders out there. But the market is likely to continue higher. That would be my bet. Again, what would invalidate that view, what would switch that view and require reassessment, would be if all 4 of the trading indices, the Dow, the S&P, the NASDAQ, and the Russell, were to close below Wednesday's lows. Now, further out, the higher we go, you know, the more extreme you're going to get in this breadth work. And in particular, if you take a look at the 10-day moving average of advancing issues, it continues at each successive high. I mean, there was a peak back here in September. Then you had another peak here. This was a momentum peak, and you can see how much higher the market went. I've said a million times, this is sort of a blunt instrument. It's a guide, etc. And then we finally topped out in November for a little short-term decline, and you can see the divergence that occurred there. And now we've traded in new all-time high ground, and the 10-day moving average is diverging again. Now, this isn't a sell signal. It can't be used that way. It's a heads up. It merits watching. And before we get anything of significance, what I would expect to see would be higher prices following some sort of more rotational market, maybe 2-3 day balance forms up in here, who knows. And then breadth forming these divergences that it always forms, always at tops. Now, the caveat there is is that you get a million false signals. I mean, this was a divergence too, and the market from here went up considerably. So you can't just, again, you can't rote trade this. This is information to help us to determine market condition, and we drill down from there. If the market condition is this, and we make certain assumptions, which onto which we can apply strategies and tactics that help us try to exploit that particular market condition. Hope you found this helpful. You guys have a great weekend. We'll take it up again next week. See you.